All right, everyone. Hey, we're going to be talking about what we call the legacy banking system, which is a system that we designed to build around these concepts. Number one is having the right financial instrument. Number two, debt elimination design, helping our clients do that. Number three, investment strategies outside of what outside what the clients are normally used to, and then also having smart money advisors. And that is a mission that we have to do that with our clients. So in that, let's talk about infinite banking and infinite banking system. So basically, how people usually use banks is this. They're depositors, right? We have our money, we go to a bank, we deposit that money in the bank. And then the bank uses that money as they leverage that money to take it out as loans. They also invest that money into other areas, right? They use our money. They call it OPM, other people's money. So they invest it. Now, here's the thing: when they invest that, they're getting about 10% interest on average on that, and we're getting as depositors less than 1%. And quite honestly, I think they're probably getting better than 10%. And we're actually probably getting lower than 1%, right? I think the interest rates has been ridiculously even worse. So that's when that happening, right? They're winning, or they're taking advantage of that investment by 900%. So they're really capitalizing our money, and we're getting at the very short end of the stick. Our depositors are getting very short end of the stick with that. What we want to do is show that there is a better way. So many people, I know I have asked myself I wish there was a way I could profit from paying my bills, or I wish there was a way that I didn't have to waste my money's potential, because every time you use your money, you're wasting that potential for earning more money off of that money. So this is where this powerful thought have came into, and using this particular IRS code, which is IRS code 7702, to empower us to use insurance as a way to empower your money to grow and to leverage your money for yourself and becoming your own bank. So basically, that rule basically says that any money that's connected to life insurance now become income tax free and capital gains free by law. Now, now, by the way, this has been going around, or this area of the law has been around for quite a while, but has been using as an investment strategy since 1984. And so that's something to know, that this has been doing for quite a while, and a lot of people have used it. Now, what normally people do with investments, they put their money into things like IRAs, 401ks, 403bs, TSPs, SEP IRAs, which is something for business owners, pensions, all those areas. Now, all these thinking, when you look at those particular destinations, those are what we call retirement plans. And what do I mean by that? That means the money that goes in there is what we call tax later position. They're not taxed right now. They actually could reduce that to your tax burden right now. However, later on, you will have to pay taxes on this money. So they all become taxable income. They also are all open to market volatility, which means if the market loses money, they could lose money also. They all are considered, again, retirement plans. So if you access that money prior to 59 and a half, you will have to pay a penalty on top of your taxes. And then lastly, all of those programs also have fees all the way through the program. And those fees are very, very important, because those fees interrupts or impacts your ability to have your money earn and grow. Okay. Now, what we're looking at is with this particular plan is say, hey, if you put money into your policy, we kind of look at it as a cup, and that money goes into that policy after tax. But now the money that you take out, if you want to use the money, is tax-free. The money is also penalty-free, and the money is what we call risk-free. So that's free from any market volatility. So again, it's tax-free money. It grows tax-free, and when you go use it, it's tax-free. There's no penalties and there's no risk. And the way you could do that is through permanent life insurance. And what we're going to be talking about specifically is whole life insurance with a position where you can really take advantage of this versus banks. Okay, so let's look at that of creating a personal banking concept. So this is creating that personal banking concept. One of the things that you want is to have a dividend paying whole life insurance company so that you could structure the cash value inside of it, right? So let's look at this policy. And what I'm going to do is compare it to traditional policies. Is that the great thing about it, we can control the design. Normally, within a normal policy, you put 50% goes to the cost of insurance. Permanent policies or whole life policies, 50% probably gonna go to the cost of insurance, and 50% on average will go to cash value. Now, with this particular type of policy that we're talking about, we're able to move around that formula so that you can reduce it to 20%, 10% to go into cost of insurance. And that means that more money will go to the cash value, which like 80%, sometimes even 90%, depending on how you design it. Now, that's important because that means if more money goes to the cash value, you're going to get more access to money, right? Now, we want to compare this to our banks. And I remember what we all remember of our regular bank account. Right now, the regular savings account is getting you under 1%. Most CDs is under 1% or sometimes even under 1%. So what we're looking at is that after tax contributions, now, if we look versus the guaranteed part with these whole life insurance companies, you get 2% to 3.75%. So that means that's a 2 to 3, almost 400% increase versus what you would get at a bank. Now that's great. Now the cool thing again is that you're going to get dividends on top of that guarantee. So let's say you was getting a 2% guarantee and you could get up to 10%. Now the cool thing I've looked since going all the way back to 1990, they have never given or they have averaged over 5% dividend growth over those times. So if you look at that, just minimum, that's about 7% growth, right? That's great. Now, one of the things we're going to show is how to have compounding growth uninterrupted, which is how you build wealth, by the way. You want it uninterrupted, which means if you're taking money out from it being put in, you're interrupting it. But we're going to show you how to keep the money there uninterrupted while you're still able to leverage the money. But you have immediate access up to 90% of the cash value. And remember, there's no Wall Street fees, there's no market risk, there's no penalties, and there's no taxes, basically, after you grow in there, right? So the money is going to go in the ledger. The ledger with the insurance company is going to give that growth, and it's going to continue to stay on the ledger. That becomes your collateral within the company. So that money stays on the ledger, or you put it on the ledger, and they have that. That's your part of money. And now you're building your personal bank, right? You're building your personal bank. That's what's happening right there. Now, whenever you put money in the bank, you also want to have some ability to borrow from it. Now, you can always withdraw, but if you withdraw the money, that means the money is gone. But we want to show our clients how to leverage the money, which means they could borrow from it. Now, how the borrowing look at about 5% simple interest with the money that you borrow from it. Now, let's focus on simple interest versus compounding. This is just a quick example. Let's say you had $10,000 growing at 4%, and we already talked about how the dividends have never went past under 5%. So, and they have averaged about 7%. So really, this is what we call very conservative. But let's say you just did that at 4%, fixed rate over that 5 years, right? That means that you're going to have about $2,200 of interest. Now, if there was simple interest, the $10,000 again, simple interest for that 5 years, they will only incur $1,300 of cost. So that means that you actually made money on the loan, right? You actually made money on the loan. You was in the positive with that loan on that position, right? About $900 or so. That is important to understand, is that if your client is now taking a loan from off of their money that's on the books, they're actually going to earn more money than anything they spend. So they're earning money on the loan. Now, they also can repay. Of course, you can repay loans, and you can repay it. You can repay it with interest. You can pay just the interest. You can pay any amount. You can pay just the dividends. And when we say any amount, that means you could pay absolutely zero also. Why? Because you have the collateral. So the company is basically looking at it no matter what, if you decided not to do the loan no more, or you decided not to keep the policy, they would just take whatever you loaned already and take that out of the cash value, and you will get absolutely the rest. So that's the power of this, is that now you're becoming a place where you could use money to go ahead and reinvest, use money to purchase things, use money to take care of expenses, and still have the money earning interest at the principal right there. So that's the power of that. And that's what we love about this. So let's give you an example. Let's say if you was financing a car. It's an example, let's say the car is worth $50,000. You're going to get a car. You could go to the bank, or you could use your own personal banking policy, right? Now, let's just say if you went to the bank or did a financial institution and they say, well, you have to pay $889. So you got per month for the car payment. Now, if you went just to the bank and did that, you would pay $889. You would pay interest on top of that. So if you did that for 6 years, right? Now you're paying another $14,000 or so on top of that. So on top of the $50,000, which actually that's pretty low, right? But I'm probably paying more. But hey, that's just story conservatively, right? So you would still have to pay that, and then you have a car left over at $10,000. That's all the car is worth. But what we're saying is, if you run your payments through your bank, so you're putting in like $1,000 in there, but you're taking back out $889, and you're doing that, you would capture the $50,000 onto your ledger. You would then capture the interest of $14,000 that you were paying in interest, so you're paying back to the bank, and then you still have your car. So you will have a what we call a gross, your gross net worth is $74,000 right there, right? But remember that money is on the ledger, and that's the cool thing about it, is that money is on the ledger getting interest. And if we're doing this calculation at 4% interest, compounding, that means that you will at least get another $6,700 in policy interest, which means that now you have a gross net worth, gross worth of $80,000 over there, right? But you have another almost $7,000 to use for whatever you want. Now, one of the things I also love to show my clients is that if you keep on putting that money in there, it says, say you keep the $889 going in there, you would now build up, like in the next 6 years, another $64,000 on top of the money that you already have in there, growing interest for you, compounding, and you can now have even more impact on your finances. You could get out of debt quicker. You could buy maybe your next car outright. You don't have to even use any loan system, right? You could do so many more things with that because you're having access to money. So becoming your own bank give you ability to eliminate debt, ability to create capital, ability to grow and use your money tax-free. And then you also go ahead and can reinvest your money out there with safety, with a safety net behind it, so that even if the investment goes bad, you still have the principal protected. So be your own bank is the ultimate wealth building strategy. It's allowing you to protect and keep a strong foundation so for you and your family could become strong.